Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Hey, Mark, happy Friday. I was saying that we kind of look like we're green, but you're telling me it's more blue. I'll give it a 7 out of 10. Happy Friday.
Yeah, I mean, the shades are very, very close. And, again, we don't coordinate except, telepathically. I do have a flash of light green, for the hope for green candles. Cause I am, do the quick review. I do have the orange pant game today. For Bitcoin Friday, and I'm wearing the Bitcoin sock game roller coaster, and it's a little early for roller coasters, right? Because it's only January, but we've been on a roller coaster. I mean, we are exactly where we were a week ago, and we've gone up and down twice, and we're exactly where we were a month ago. Big up, big down. So the roller coaster is back. The problem with the roller coaster, right, is you go around and up and down and you end up in the same place, right? You come back to the exact same place. So I'd like to get off the roller coaster here. And look, I do this annual 10 surprises thing. So it was last night, and way too many slides, but it's amazing, the variance in belief about Bitcoin. I mean, I had dozens of slides of people who are like firmly believing what they're putting out there. And it was everything literally from 32,000, right? That we are going to crash just like after the 21 cycle. And we're headed for 32,000. And equally vehement were people saying, we're going to be at 250, by middle of this year, and 250K. I'm like, are you kidding me?
Middle of the year.
So I struggle with why at this point, right? We're 17 years in, and volatility has been contracting. So we don't have the massive vol that we used to. Why there's still such divergence of thought. But it's there. And it was interesting. There's so many indicators that people use, right? There are people that just look at the past cycles and say, okay, just based on the past cycles, this is what's going to happen. There are others that, try to get a little more fancy with, charts or lines on charts. The one that I thought was quite interesting. There's a group. So there's something called the banana zone, if you're a technical trader. And basically it means you get a parabolic move because there's a lot of retail involvement and things get extended. And then, literally you slip on the banana peel and you have a crash. And so you get these banana-like arcs. And, I think Raoul Pal and a few others called this the banana zone, that we're going to go parabolic and everything's going to be great. Well, there's this technical analyst, Peter Brandt. And Peter is a legend. I mean, he's one of the original kind of turtle trader, like technical analysts. And he's very sober about everything. And he put out this really interesting thing. So there's one group of people said, banana zone is gone and we're in the cucumber market. What's the cucumber? And so they said, the banana is curved. Well, the cucumber's straight. So another, fruit or vegetable. And because institutions are here, we're just up only, right? We're not going to have any more volatility, which is clearly not true, because I'm wearing the roller coaster socks. But Peter said, no, we're still in the banana zone. It's just that the arc, right, of the long-term parabola, which is the Metcalfe's law curve, is changing. And so when you're on a high incident angle of incidence, right? Your banana is going to look different than when you're at a low angle of incidence, and your banana is going to look different. And he said, look, based on that, we are in winter. We're in the fourth part of the cycle, and it's going to last through third quarter this year, kind of, September-ish, early September. And, his number was 63K. And he gets that from, again, lines on a chart. I go to Tim Peterson, lowest cost forward is 71K. If you look at electricity production, it's 71K. We rarely, like only a few days in 17 years, have we traded under the electrical cost of a Bitcoin. So I think that's probably the downside, which means you don't have a lot of downside from here. But it also means we're not going to 250K, anytime soon.
Yeah. I think that prediction was certainly rich, in all the ways. And I always get a little bit sensitive when I hear terms like up only. Mark, it reminds me of the podcast by the same name, Up Only, which was sponsored by whom? FTX. So that podcast went off the air right at the same. It was one of the biggest podcasts in the business. So we want to be cautious with that. But maybe, Mark, one of the signals here of relative strength is another fresh 2026 minted IPO. BitGo has debuted as of yesterday. Market's kind of just opened here, so there's not a ton of activity, which I think is a good thing. But basically, the snapshot of these guys. So they were valued at an IPO price of $2 billion. It went up about 25% to start Thursday's trading at $18 a share. They provide custody and security services for digital assets, primarily on the institutional side of things. So to me, this is not a speculative business. This is very much, if things should be logical, which sometimes they are not, but I think in the long run, things do tend to be logical. This should be a bellwether for our industry. Companies like BitGo, maybe not BitGo specifically, they have to stand on their own merits, but providing the actual infrastructure for institutional clients, this is what in theory was propelling the rallies that we saw when the ETFs came out, when the legislation came out.
Absolutely.
Here they are.
I mean, look, and, humble brag, right? This is our sixth unicorn. And look, and we're not even, the best of the best, but whatever.
Yeah.
But it turns out we're reasonably good at this venture thing. And the idea that 6 companies that we backed back in 2018 to 22 have gone on to $1 billion plus valuations is awesome, right? I mean, again, we didn't have anything to do with it in the sense that we didn't build the companies, but we at least were supportive of this idea that, as you said, infrastructure, the infrastructure layer, the picks and shovels of the digital age. And, I even wrote this long paper, I think it was like 40 something pages on the digital gold rush back in 2018 or 19, maybe it was even 2017. And it was, look, in the gold rush, it wasn't the gold miners that got rich. A few did, right? A few found the big nuggets. But the people who got rich were the people who sold the picks and shovels. And, actually the first millionaire in California was the guy who owned the general store in Yerba Buena, which was still called Yerba Buena, now San Francisco. And that's just interesting, right? It's funny, it's egg prices. So, egg prices, they were all the rage last year. They went straight parabolic. And now, like every day, egg prices are collapsing because, they didn't kill all the chickens like they did when they thought bird flu was coming. And so the trueflation number, now this is an amazing thing, total non sequitur, but this is totally. So Trump is at Davos and he's up there talking, and he's talking about core inflation of 1.5%. Like, on what planet are you talking about? No. Core inflation is 2.7% and PCE is 2.8%. Oh, but there's this trueflation number that arguably is maybe a better indicator. It's like millions of actual prices. But it's being driven down. It went from 1.5 when he said it on Tuesday to yesterday, it was 1.2 because egg prices are collapsing. But back when Sam Brannon was selling eggs, they were $6 per egg. Think about that. In 1849, $6 for an egg. So you could go out and sit in the cold and try to dig in the ground to find shiny, yellow metal. But one other little thing, and Meltem Demir's, which has to be one of the great names in our space. She's a great analyst and investor. But where did it go? She just sent out this picture, and shoot, I'm not finding it. So it was a picture of stores of value. And if you've been watching silver and gold, they've gone totally parabolic, right? I mean, completely parabolic, like almost Weimar Republic, kind of crazy vibe, like hyperinflation vibe, but totally parabolic. And they've gone from 15 trillion of value collectively to 40 trillion of value together. And Bitcoin and Bitcoin et al., crypto, have gone from 4 trillion to 4 trillion over that same period. And so it's interesting that, we talk about digital gold and it goes to, again, get sinister Saturday early. It goes to this problem that we have with futures and the pressure on the spot price from the futures market. And, I just think it's going to take time. I mean, we are 17 years in, and that's a good long period of time. Maybe the first 5 were not really, they didn't really count because it was a science experiment that very few people knew about. But now we're, 10, 12 years into a 30-year cycle, but 30 years is a long time. So we still got a long time before people really accept that digital gold is as effective as tangible gold. And here's a stat that again came from the 10 surprises that I think most people don't realize. For the first time in over 50 years, so really since Bretton Woods, post Bretton Woods, since the gold window closed in 71, for the first time in 50 years, gold makes up more reserves of gold central banks than dollars.
Wow.
Right?
Big shift.
So we did 44, we did, Bretton Woods. And then in 71, we cut this deal with the Saudis and we created the petrodollar system. And a lot of central banks around the world put reserves in dollars. And that was good for us as the world reserve currency. But in the last couple of years, Japan, China, Russia in particular have been buying gold literally like it's going out of style. Like literally it's going away. Despite the fact that they claim there's this meteorite, right, that they're going to mine, some crazy number, like it was $100 trillion of gold. I'm like, probably not, but okay, sounds good. I did remember the movie with Liv Tyler and Bruce Willis.
Armageddon.
Oh my God. Loved that movie. It was so
great
good.
soundtrack.
So
great
good.
soundtrack. Yeah, we'll see Mark on the IPO. Yeah, love that soundtrack. That was Aerosmith's big comeback with "Don't Want to Miss a Thing." If you recall that one for your guitar fit.
Yes,
So that's
my very first album of all time, Columbia Record Club, Aerosmith Rocks. That was my very first. Kiss Alive was the second. Both epic. I mean, I get warm thinking about them. So good.
Excellent. They're definitely on the Mount Rushmore there, and with as it relates to BitGo, Mark, one thing that maybe had slipped under the radar, which I think could be important. Speaking of the point about gold mining, is unlike other crypto IPOs, they went fully native, right? And so they put their shares on chain day one.
Yeah.
Through Anando partnership. So that means that you can have tokenized Bitcoin shares on ETH and Solana and BNB chain.
Yep.
So we know that some folks have discussed this in our orbit. And, right now, if I'm being honest, Mark, it's probably too soon for me to tell, to see, what sort of volume here. And then we had a discussion about this just yesterday in our partner call about, as a publicly traded company, what other mechanisms are you going to employ to just have movement in your shares, which could boost your share price?
Yep.
One is you can buy all of them back, right? Which is what we did.
Stock buybacks. That works really, really well, actually.
Ask Apple. Works. Or exactly. Ask Apple. Ask anybody who benefited from some of the TARP funds that took place in the COVID era. Or this is the big, possibility here of listing them on chain and thinking about, could this bring in a new wave of demand and things like fractional ownership? I can see both arguments here, Mark, and I'd love to hear your take, because when we think about things, speaking of gold, for example, the tokenized gold market has also gone parabolic. With the thinking that now, as you're opening up access and you're creating, and doing away, let's say, with minimums, that could enter in a whole new level of buyers. But my worry with this is that the buyers that are entering this are highly reactionary and highly unfocused. However, we all know the kind of, sunk cost fallacy. So folks that are on the retail side, more disproportionate than other groups, they tend to hold when they should sell, and they tend to sell when they should hold, probably because they don't have the same boardroom conversations as, the Griffiths of the world. But what say you, Mark, and say, tokenization as a way to increase
tokenization is the future, right? And New York Stock Exchange said the same thing, although they were a little light with the details on what chain and what tech. Our portfolio company Figure is exploring tokenization of a portion of their shares. BitGo did it from day one. Mm-hmm. It is the future. I mean, there are hundreds of shares tokenized now on Coinbase that you can trade. Now, to your point, many people view that as, well, that's just fueling the casino. That's putting more games of chance in these degenerate traders, gamblers. Like, guys, that's been going on forever, right? Penny stocks have been gambled on for years, and Robinhood and others have created a point and click mentality for quote unquote investing. It's not investing, it's gambling. But here's the thing about it. There's a great stat. So everybody's like looking at Robinhood, and it's stocks gone parabolic and Coinbase gone parabolic because they are getting lots of new customers. The problem is their average customer is teeny. So there was a chart that showed Vanguard and Fidelity like 270,000 per account, and Robinhood was $4,000. And that's not a criticism of those people. They're young, right? They haven't accumulated wealth yet. And this is why Vanguard was so staunchly against listing Bitcoin stuff, because it made their customer base antsy, and their customer base is old, right? It's all the people like me. And they actually have all the wealth, right? The boomers own $40 trillion of wealth, most of it sitting in traditional brokerage firms. Now, when the boomers pass, which, sadly is happening now every day, because, the original boomers were born in 46. Although, one quick one, life goal. I tweeted about this. So I'm at the Carolina Notre Dame basketball game the other night, and sitting in front of me is this gentleman, and he's got this gold hat. And these are very famous gold hats in Notre Dame fandom, because you can only get one. It's called a Golden Domer hat. You can only get one when you're 50 years out. Okay. So now we know that he's at least 50 years out. And, I'm 40 years out, but okay, he's 50. So I'm getting closer. But then we get chatting with him. He's not only 50 years out, he's 72 years out.
Wow.
Class of 54.
Wow.
At the basketball game. So 93, I'm like, that is my life goal. That I want that, right? And it was just very inspiring. And so I'm 2/3
where you are. Hopefully you were listening.
Yeah, I'm 2/3 of the way there, right? At 62. But it was awesome. And he was there and he was cheering, and like, dang, that's what I aspire to. But shoot, where are we going?
Speaking about, if the tokenization
Oh yeah.
can lead towards greater sales and appreciation of the underlying stock.
Oh no, where I was going with that was the people that own the assets.
Yeah,
they're going to pass. And
right.
that was the crazy thing. I mean, this is kind of a sad little thing. He said at his 72nd reunion, only 6 guys. So, but I mean, that's the way life works. But the point is that the boomers have the wealth, but it's going to their kids and their grandkids, and those people aren't going to keep it in the traditional world. So it's going to migrate on chain. And yes, there will always be a layer of gambling and fast trading. And that's not facilitated per se with tokenized shares. It's not, right? It's you can do fast trading with a small amount of money on Robinhood. That's the same thing. It's just ultimately you're going to take cost out and you're going to have better infrastructure. And I had a slide yesterday on just a reminder on what Bitcoin is, right? And why it's important and why digital assets are important. And you think about it, Bitcoin is money, right? That doesn't need a government to issue it. It doesn't need a security guard to guard it. It doesn't need it doesn't need an accountant to audit it. It doesn't need a physical vault to store it in. It does so, and digital is just a better form of record keeping. And when you take the same thing with shares of a company, a physical paper certificate, which I own some, the collector's items, that's 800-year-old technology we don't need anymore. And it's inevitable, but it's going to take some time. And the incumbents are going to fight it because transfer agents and, auditors like their jobs, turns out. I mean, I couldn't do that, but not a detail guy, but they like being employed. And, someone asked the question, when was the last audit of Fort Knox, right? Like 1940 something. When was the last audit of Bitcoin? 10 minutes ago. So that is interesting because, it's real. It's a reality check on, well, you know what I mean. So
yeah, but on that point, Mark, maybe we can pull the thread here. This is a topic that I've been meaning to speak about as we think about institutionalization of crypto. The idea, and I don't think that this is a bug as much as it is a feature of when Bitcoin and other coins started coming out. They had kind of a core set of principles: anonymity, decentralization, and trying to basically franchise the disenfranchised, right? Let's remember where this all started on the Occupy Wall Street movement, which there was a whole lot of challenge going on in the markets at that point in time. As we've kind of migrated now further up the S curve, now a lot of those folks that were disenfranchised are now very much franchised, very much a billionaire class, and kind of act in different sorts of ways. This has given rise to something else, Mark. This has given rise to the privacy coin, right? So what is the privacy coin? So privacy coin almost is like going back in time.
Yep.
So if we've got to a point now where, let's say Bitcoin still continues to be anonymous, but there's obviously a public address, and we always speak about it on our show. We see the movements of some of these addresses and they tip markets, and sometimes you can link them to individual accounts, and sometimes these people are actually publicly known.
Sometimes people dox themselves and they put their address online.
Go figure, right? But the privacy tokens are basically a kind of different construct. They allow the blockchain user to hide certain transaction details like the sender, the recipient, the transaction amount, the wallet balance. Okay, so this is getting a little bit murky, but they use things like ring signatures and ZK snarks, which are actually really complicated things of technology, which they basically allow a transaction to be valid with a certain amount of conditions. So what does that meant for performance? Mark, some of these have performed fabulously well over last year.
Yep.
Like, Zcash has done incredibly well, and a couple of others. But, if you think about the outlook for 26 and some of these tokens, there's a little bit of a risk here, right? Because we are moving towards less opacity, more transparency and regulation and government oversight. This is what we say. We can't kind of have it both ways. You can't say, we want regulation, and then say, we want specific kinds of regulation.
Yeah. Look,
look,
I think the technology and the advancements in the technology, decentralization, self-custody.
Yeah.
All these things are great, right? I mean, be your own bank. We're having this whole debate on the Clarity Act, and why don't the banks want the Clarity Act? Well, because the banks kind of like the fact that you put your money in their bank and it becomes their money, and they pay you almost no interest, like less than 1%. And then they can charge 7% for a mortgage or 25% for a credit card, and they make a lot of money. And all the while, they put the money at the Fed, and the Fed pays them 4% for free. So, Moynihan went and said, well, if stable coins were allowed to pay interest, $6 trillion would leave the banking system. Yeah, it would, because that's how competition works. If someone's going to pay me 4 and I get 0, I'm going to come over here. So that's not a bad thing, but they're going to try to do regulatory capture. But look, bearer assets have risks, right? In the olden days, right, gold miner time, you took your gold and you went and you exchanged the gold for paper money, right? And you put the paper money in a suitcase and you got on the stagecoach and you went off. Well, then people would come down and they'd rob the stagecoach and they'd take your physical bearer asset. So let's say you made it to the bank and you put it in the bank, and they literally took your suitcase and they emptied it out in the vault, right? And they closed up the vault. And we've all seen the movies, right? And the guys came with the sticks of dynamite and blew up the back of the vault and took the money. So what did we do? We said, well, maybe we could turn the physical asset into this electronic thing and we could store it differently. Okay, well, we need a centralized authority to do that. So we went from a bearer asset, these physical pieces of paper, to this non-bearer asset, but the centralization meant we had to give over control. Okay, well, now we have these digital assets, a Bitcoin, and I can hold it on my ledger device, and it's mine, and it's a entry on a network on a ledger, and I don't need the bank or anybody else. But if I lose my little ledger device, well, then I get another one. But if I forget my seed phrase, or God forbid, I transpose 2 letters or something, gone forever. Forget my password. Okay, so what do we do? Let's create CeFi, centralized finance, Coinbase, others, that will help us with the bearer asset problem. Sounds good. Oh, no, that's horrible. Well, why is it horrible? Well, it's horrible because now we are subject to the same problem. So let's use back to stablecoins, flip-flop back to stablecoins for a second. So stablecoins, in theory, if I have stablecoin, I can send it to you. No questions asked, no governments involved, no banks involved. Okay, well, what if I'm a bad guy? What if I'm now, I don't consider people who live in Iran bad guys, but the US government does. So, which is kind of crazy, like everyone who lives there, not just the bad people, but
rush.
I mean, everyone who lives there is a bad person and shouldn't be able to use money. Maybe that's wrong, but sanctions, okay, you can sanction people if you can control their money. So with banks, you can control it. Well, now with the stablecoin, you can't. Well, unless you say, okay, if you bought a Tether, the US government can now go into Tether and say, I just froze your accounts. They just did this. They froze the accounts of a bunch of Iranian people. Like, that sounds less good than decentralized. And so, Brian at Coinbase has resisted so far the government coming in and saying, I need to see everything. I need to be able to control, who's using your accounts, and you need to give me their number so I can charge them taxes. He's like, well, no, they have to self-report their taxes. And it's kind of like, brokerage firms and banks, right? They tell the government how much they paid us, the little 1099 thing. Like, well, okay. This is one of my bad things about taxes. Like, so all that information goes to the government. So the government knows how much you're supposed to pay. And then you have to figure out how much you're supposed to pay. And if you guess wrong, you get in trouble. Like, if you know how much I owe you, just tell me. But in a world of, again, but that would lead to 800,000 people not having jobs who do all the taxes. So I think this goes to, we're going to get to fully automated and fully decentralized, but it's going to take time, and it's not without its risks. Like, most people that buy gold don't have the physical bars in their house. Why? Because people would come to your house and steal it, right? So they put it in a vault somewhere and they pay for storage, or they buy paper gold, which may or may not be real gold. So all of this goes to the same age-old problems. For millennia, we've had this problem. I have stuff that I want to protect. How do I do that? Well, I could have a gun, right? That's one way. So don't take my stuff or I'll shoot you. And that was the cowboy way, right? But if someone had a bigger gun or just a better shot, they take your stuff. So that was a less good system. So then we went to these institutions that were there to help us. But the thing I love about, back to ZK Snark, so this is a long winding way to get back to your point on the technology. If I have a Bitcoin wallet and I want to make a transaction with you, you don't really need to know how much Bitcoin I have. You don't really need to see what the last transaction was. Like, I love the fact that people leave Venmo on so they can see all the transactions that you've done. Like, it's how people get caught in fairs and all kinds of stuff. It's like, you and your wife's like, why did you send flowers? You didn't send me flowers. I mean, so bad stuff happens, but I'm not trying to hide any bad stuff. But my point is, you don't need to know that. All you need to know is somewhere in there, I have the Bitcoin I say I'm going to send you. And that's good. And I use the simple example, again, as the dad of a daughter who happens to be sitting right out there because she's on baby watch. We're very excited. Baby's due today-ish, but sometime in the next week, we'll have the number 4 grandkid. But as a dad of a daughter, I don't like the fact that when she wanted to go to the bars in college, she had to show her address. All he needs to know, are you 21? You don't need to know her birth date. You don't need to know her eye color. Don't need to know her weight. You know, all you need to know is she 21? So there should be a encrypted form of, yes, I'm 21, and it tells you with a reader that you're 21. Okay, you can come in. And so privacy is important. Secrecy, less good, but privacy is a fundamental human right, even though a lot of people don't see it that way. Like, they're listening to us right now, and I'm going to get served a bunch of stuff on my phone later because it's listening. Anyway, I digress.
Yep. I think that, it's a good point. I think for us, like, what we have highlighted before is this is part of an S curve. The more people you bring into an ecosystem, the more those rules are going to have to expand as there are more participants that have different needs. And I think, we saw that with Bitcoin. We've seen that with AI. And obviously we're going to see that with as they become more mainstream with, upstarts, or in Dcash's case, folks that have been around for a while, but have now given new opportunity to kind of fulfill some legacy gaps. But Mark, before we kind of slide into the next segment, I was wondering if you had a chance to see what's been happening with Intel today that has reported some earnings that were a little bit soft. So on the compute side of things, to put it mildly, they're down 15% in a day.
Ooh.
And I remember when is this their DeepSeek moment? We will find out. But obviously when NVIDIA went down by a similar margin, the world took a break and paused. But I feel like, when we think about Intel, we kind of have been seeing this iceberg begin to melt for a little bit of time. Their margins have been getting compressed, and obviously their revenues have gotten a little bit flat as they face mounting competition from AMD and some of the others that have now kind of caught up. You've said it well many times, Mark. When you in the earlier days of compute and Web 1, Web 2, you had a special VIP club card, which was that Intel Inside sticker.
Little sticker on the corner of your laptop. I mean, on the corner of your desktop. I mean, Intel Inside. I mean, genius marketing, by the way. I mean, absolutely mad genius marketing, and it was the best of the best. Look, I am old enough to remember that Intel in 2000, from 1990 to 2000, went up 20-fold, 20-fold, and peaked, and everybody was basically saying, they're going to change the world, and their chips are going to be used for AI. Back in 2000, they were all about AI, and we had Clippy, but they were the dominant player. And oh my God, the first time I got a Pentium chip in my computer, oh God, I thought I'd gone to heaven. I mean, it was incredible. And then AMD would every once in a while kind of start to catch up, and then Intel would smack them back down, whack-a-mole. And Intel was just the dominant player. And then NVIDIA comes along, and they start making these graphics boards. It's like, great, graphics boards are good. My Intel Pentium with the graphics board, now I can play cool games. And then the engineers just kept working, and they kept innovating, and they found, hey, wait, we could do some of that CPU calculation with these GPUs. And what we saw was this, right? The X, right? For you, the X, in that Intel just kept eroding. Now, why? Was it bad leadership? Was it, too much tech debt, meaning you had all this money invested in fabs and machines, and you didn't want to give up? And in many ways, this does happen over and over and over again, in that the incumbent is so wed to the gravy train of what they built that the upstart competes some of it away. And it's, right. I said, Netflix versus ABC, NBC, CBS. No one should have been able to dominate media better than the people who owned all the rights to all the media,
right?
Networks. But somehow they let this upstart, get share, and then get to the point where they're making content. Now the content they're making is kind of dicey, but some of it was pretty good. And long story short, this is what happened to Intel. Now, as a saving, or as a Hail Mary, since we just ended football season, by the way, I am going to say, I was not a Mendoza fan early on. I just didn't. There's something about him I didn't really love. But oh man, I am now the biggest Mendoza fan. That just had the clip with Jimmy Fallon last night. I mean
that young man is. First of all, I think his story is incredible.
It's incredible,
right? And he can inspire a lot of people. But I mean, he had so many moments in that game. Obviously, sidebar here, but I mean, maybe you saw now on replay. I'm not sure if you saw it live, Mark, but you probably have seen the highlights.
I did give in and watch, and it was incredible. Incredible.
Dies for a touchdown. I mean, gosh, it was a great game. Great game. It's one of those games where you hate to see somebody lose. But in Indiana was clearly it was their game.
And that's my thing. No one lost that game.
Yeah.
Indiana won. And there's a big difference, right? Alabama lost. Alabama got the tar kicked out of them, right? They lost. Miami didn't lose. Indiana won. And there's a very big difference, which made me even more mad that Carson Beck didn't shake hands. So, the contrast between those two is pretty amazing. But anyway, the point there is that, you have this Hail Mary of the government saying, all right, we'll give you some money, but we want, 10% of your company. And on that announcement, Intel stock went way up. I was like, okay, well, they didn't really do anything. And, but we're going to repatriate all this technology back from Taiwan because TSMC has been dominant and Intel has been losing. Like, really? You think you're going to build a fab in Arizona that's going to compete with Taiwan? Probably not. I mean, maybe, but so far doesn't appear to be the case. And to your point, the numbers on the page are not looking so good.
Yep. Not looking as great. Well, this is the time we will transition away. If a picture is worth 1,000 words, a chart is worth 1,000,000, at least, if we're counting.
At least. And if it's picked by X, it's worth 2 million. So
here we go. So as we kind of think about, where are the markets headed, there was actually a pretty good conversation, Mark, about DATs. And actually, we also spoke about that as well. The digital asset treasury companies were very big buyers of crypto assets, certainly last year. And there was a little bit of a cause for pause in October. And, there has been somewhat of a rocky start since that moment in time. But, the big ones continue to buy, and the little ones also must buy to survive, although
right.
they have come under more pressure and threat. So I will want to show a little bit of a market capture here as far as what this looks like top to bottom. So I will share my screen and let me know when this has come into view so we can exactly see, just what this has meant for some of the market activity over time. And I have a couple of charts to illustrate the point. Okay. Wonderful. Here we go.
There we go.
So as we kind of see the total accumulation, so they're the new entrant, right? The new not new entrant, Mark, because for those that have been following us, we speak about Sailor. We actually didn't speak about Sailor today. I thought we were going to go the whole time, but we've somehow now spoken about Sailor.
Yep.
And it started this model in 2020. This snapshot goes back to the start of last year. And you're probably the foremost expert here, Mark, on the show as far as, what it means for the Bitcoin side and how DATs can really move markets and create shareholder value. But there have been others, right? So we saw Ethereum come to the forefront, and obviously Solana has had its moments as well. But you kind of definitely see a sell-off towards the end of the year as, the MNAV multiple, which is, the multiple net asset value, is really what a lot of traders look for in terms of, is this a good deal or a bad deal? So maybe we can just kind of dive in a little bit there as we kind of look at last year and maybe shift gears towards, what this year can hold moving forward, because this was the time also where corporates became the foremost buyer by percentage of Bitcoin specifically and other crypto compared to ETFs. So your thoughts, Mark, when you kind of think about that?
Digital asset treasury companies are a pretty simple construct, right? You are issuing shares to raise money to buy this asset that you believe is going to appreciate over time, or not be devalued over time. And it's been a genius strategy. You can see on the left-hand side of this chart, the blue bars in particular, very consistent acquisition of billions of dollars of BTC. And a couple of points that are important here. So one, the total purchases, the total lines there in the Dukish blue, the royal blue, far exceed, like by 5 times, the number of Bitcoins that were actually mined. So that means someone, right? And we found out it was, some whales, some others, some traders that were on the other side of the transaction. Because, I always say there's never more buyers or sellers. There's always an equal number. So someone has to be selling. And really the left-hand side of this chart of the royal blue is mostly Michael Saylor and MicroStrategy, but also, company that I'm a board member of, Metaplanet, buying a bunch of Bitcoin with this, ability to issue shares, because the MNAV, the market cap, the market value to NAV of the company is above 1. And so it's accretive to shareholders to issue new shares and buy more Bitcoin. And it's this concept of Bitcoin yield. Well, in the later stages of the year, when the price starts to fall, you see that the lines start to get small, and then they actually just disappear in November. And it's because if your share price falls below NAV, now you can't issue new shares. So if you're Michael Saylor, so you still see a few big purchases in the blue bars, he is able to issue debt, right? So if you can issue debt to buy more Bitcoin and increase your Bitcoin yield, that's accretive. And if you get too far below, you can actually buy back your shares at a discount, and that's super accretive. So Michael Saylor built the kind of perfect capital structure to facilitate that. So on the right-hand side, most of the royal blue activity is him. Then Tom Lee comes along and does this thing, BitMiner, which was I love this. It was a Bitcoin mining company. And then he turned it into an ETH treasury company. And so you see big purchases of ETH when, again, prices were high. But then post the correction in October, suddenly you have this big fall off and the price goes below NAV, MNAV of 1, and you can't issue any more shares. Well, BitMiner doesn't have the ability to go to the bond market. And one of the things that you see this on the far right side, you see the little blip up at the end of the year. Metaplanet got approved to issue prefs, so basically debt instruments. And in Japan, they pay much more than deposit rates, which are basically zero. And the benefit they have is it's much lower than the price that Saylor has to pay his preferred holders, which is upwards of 6-7%. So long story short, I think what you're going to see is an increasing cap structure arbitrage trade. And I don't know if the ETH companies or the Solana companies have enough market heft to get it done. Maybe ETH does. It'll take a while for the Solana companies. But in the end, if you can have a fixed income instrument secured by these appreciating assets, and people say, but they're not appreciating right now. They are, okay? They are in terms of the dollars you need to buy them, or the yen or the euros, because those currencies will continue to devalue because money supply growth is going up. And all this goes back to one thing that you could see, like that middle explosion of bars. Mm-hmm. If SCOTUS were to rule the Trump tariffs illegal, and they keep saying they're going to rule on it and then they don't, but if they do that, in the short run, that will be very bad for mostly everything, right? I mean, you'll see markets go crazy, equity markets go down, bond markets, gold markets will likely rally. Bitcoin and ETH should rally a lot because the amount of money printing that will be necessary to make up the deficit shortfall will be epic. And we've already seen signs of that in the not QE, don't call it QE, where the Fed's going to start buying bonds again. So again, long winding answer to say that the trend here is positive. The short-term decline is a unwinding of leverage that was necessary. Look, humans are going to human. And when prices start rising, they buy some. And when they rise more, they buy a little more. When they rise a lot, they start to buy it with leverage. And when they go parabolic, they get stupid and they use a lot of leverage. And then ultimately, CZ comes in and cleans it up. So that's what happened from October through December. I think most of the leverage is out of the system, not all of it, but most of it. And now we go back into the accumulation zone. And I think that bodes well for the rest of the year.
No, I think that's well said, Mark. And I think that's also sentiments that some others have been echoing as well. And if you think about, this accumulation pattern that we're in, what could be at the other end of this? There are estimates that we can get to as high as 1 trillion in digital assets that are held by the crypto treasury companies, which would be a sizable amount. And there's some other forecasts that say that half of all Fortune 500 companies will continue to hold on to these assets as well, because, this is one of those rare moments where we could kind of buck the trend, as I love the quote that you say, at one other time will we be attracted towards buying things at a discount on sale than right now, right? It's the only time where we think that this is a
Yeah,
bad
look,
thing when when the prices
it
have
is
come
a
down.
strange
So
phenomenon.
what?
It is a very strange phenomenon that people run out of the store when things go on sale in investing. But we'll fix that.
Yep. And probably we probably have time for one more that we can try to sneak in here. This one I thought was a pretty interesting look at what is going on with, RIA composition, if I can find it on the screen. Now, what I think is pretty interesting, here we go. We were talking about before the latest IPO, and as Mark rejoins us, it looks like he had a little bit of connection issues. I'll kind of cue this up. As we kind of think about the latest IPO, where we had the IPO yesterday with BitGo. They are listing their shares online, or rather not online, but on chain, excuse me. And they represent a relatively small part of this pie of the total value of real world assets distributed on chain. You can see that a teeny tiny slice is in the public equity bucket here at just at 630 million. Whereas the overwhelming larger slice of this total pie is US Treasury debt at almost 9 billion. And then commodities would be the next largest category at 3.1. Interestingly, you have institutional alternative funds at 2.4 billion. That's a trend that we have been seeing quite a lot. And now we're rejoined by Mark.
Yeah. So I guess I was here the whole time, nodding and smiling, but so I was here listening. And look, what I love about this, chart is it shows that, look, when you're going to turn something into a tokenized asset, let's start with big markets. So, treasuries, largest market. But one thing that most people think equity markets are the biggest. They're not. Bond markets are 10 times bigger, and then derivatives markets are bigger than that. And then, then currency markets are bigger than that, and then derivatives markets are bigger than that. So, things like alternative funds, tokenizing a fund structure, that's totally fine and makes sense. It's not something you're really going to trade day to day. And some of the big alternative managers said, hey, this looks good. It can reduce my costs. It can get the reports to clients faster. That's all good. Things like commodities and treasuries, so logical. Like, why should you have to go through, broker dealer network and pay the, and commissions have come down and the slippage has come down. It's not like the old days of where being a market maker was literally a license to print money. And so, decimalization and automation has fixed all that. But at the end of the day, the small gray pie pieces, non-US debt, public equity, those are going to explode. I mean, they're literally going to explode, because the idea of DTCC holding physical pieces of paper and then issuing CUSIPs in electronic form is pretty archaic compared to an on-chain world. And, most of us oldsters can remember an offline world. I joke the way we figured out where people were wasn't by, where their Facebook was or whatever. It was where the bikes were parked in the front lawn. So, the old analog world, offline, and then online came along, and online world was good, and Web 1 and Web 2 created a lot of value, but on chain is superior. It's better technology, and it stands on the shoulders of giants in the sense that, I always use the simple example of when we went from, dial-up internet to broadband internet. I mean, it was night and day, but it was still the online world. And now we're going from this online world where, brokerage trading at Schwab or E-Trade or Robinhood is far, easier than the old days of having to pick up the phone and call Merrill Lynch or whatever. And it's cheaper and faster. Now, you got the issues of gamification and all that, but that's another story for another day. But in a digital world where I don't have to worry about is the market open or not open, right? It's open 24/7, 365 in an online world. That's just superior. That doesn't mean that I want to sit around in my pajamas and day trade all night, but if I need to do something, I can. And that's a better world to live in. So I think this chart is just going to, the pie chart's just going to continue to grow. It's going to keep getting bigger and bigger. And the pie pieces are going to get more representative of the total asset base, generally.
Mark. Well, that's probably a good place to cut it. And I think another congratulations, Mark, are in order again for Indiana. The state's a big winner. And again, this shows speaking of the S curves, this shows the S curve of NIL, right? Because we kind of went to a point where, we've got now 3 Big Ten champions in a row. I think next year, I know Notre Dame is a big conference, but I consider them kind of Big Ten because
they're Big Ten-y. I mean, and they should be in the Big Ten. I mean, if we're ever going to be in a conference, that's the one we should be in, and it should go back to being all regional and have coastal conferences and central conference. But here's back to NIL. Just one last thing. Back to Mendoza. The Cuban offer is pretty amazing, right? Basically saying, hey, come on, Fernando, come back for one more year and I'll make you whole, which the estimates are, which I didn't realize a rookie could get this much, but they said it would be a $23 million signing bonus, which again, I didn't think you could get.
Yeah, they changed that, right? Because they used to have these huge pay scales, and then the owners came back and went away with that because of all the liability.
I thought the rookie contract was like $475K, which is not insignificant, but I didn't think you could get. But supposedly, and again, I don't know if this is true or not. Supposedly, $23 million signing bonus and a $35 million contract. Again, I didn't think rookies could make that much, but I how do you say no to that? I mean, that Mark, seems like a good deal for Fernando. And the last thing I'll leave you with, which just goes to talent and training and discipline. And I don't know why I didn't know this, but Signetti, who clearly is a great coach. I mean,
incredible.
And the clip of him at his first press conference at IU, and they're like, how do you think you're going to turn this program around? He's like, I win.
Google me.
I was like, oh my God. I mean, wow. But I guess I didn't know this, that his dad was a coach at West Virginia. And Nick Saban was an assistant for his dad.
Unbelievable.
I had no idea that. And then he becomes an assistant to Nick, and the rest is history. I find that just extraordinary.
Unbelievable. Kurt, Google me. Signetti was actually credited with the Saban coaching tree. And we talk about this a lot, Mark, that basically Saban and his disciples now are dominating the NCAA.
Dominating. But it goes to talent. And we've talked about this all the time. Follow the talent.
That's right.
Why are we doing what we do? Why do we do what we do? Because we saw the smartest people we know migrating into this area. Follow the talent. It's a super easy construct.
Agreed. And the eyeballs followed there, Marcus. 30 million people watch that game, which is an insane number for an amateur athletic contest. We will end it there, Mark, and remind our users, as always, and our listeners to continue to check us out wherever you podcast and to always stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.